I'm a wealth manager. I manage real people's wealth. In other words, I stop people doing stupid things with their money, which is generally what people do. I'm going to talk about how the economy is perhaps not as you see it. It's not nearly as good as people make out. I would perhaps say that if anyone tells you the economy is doing well, they're either deluded, or they're trying to sell you a house, or they're trying to get your vote. If, however, they're trying to get your vote and they tell you the economy is dire, then they probably created it. As you'll see, I'm coming to praise the economy, I'm coming to bury the economy, not to praise it. Here's something which I think most people will find interesting. Major part of people's wealth is their houses, their house, maybe their investments in property. And everyone says, you can't lose with property. Quote, you can't lose with property. It's an interesting thing. In 2005 to 2007, 1 million buy-to-let mortgages were taken out at the top of the biggest bubble in history. This is a chart of roughly the last 40 years of inflation-adjusted house prices from the Nationwide. As you can see, it peaked at an unbelievable level in late 2007. You may not be able to see it from there, but we have actually gone below the long-term trend line. I would suggest to you, and you know, by all means, question any opinion or forecast that I'll make here, but don't question the facts. I'll suggest to you that where most people's wealth is tied up in their property or properties, the average value of property is going to go down to below that point there. Anyone who's got grey hairs will remember the peak of the late 1980s and then the bust of the early 90s. If the average house price at the moment is 160,000, the average house price is going to go below 120,000 over the next 2 or 3 years. 25% fall. Closer term, the last few years, whether it's Halifax Land Registry, the font of all knowledge apparently, or the Nationwide, as we can see, house prices have started a falling trend, and indeed we've had the first leg down, we're having the second leg down. I'd suggest to you they're going to go down a lot more. That, of course, has a great bearing on people's long-term financial security, particularly those who have got debts up to here. And we're kind of expecting, because it happened over the last 30 years, that over the next 30 years, their property would rise in value to the GDP of a Latin American economy. It isn't going to happen. It's not possible. Unemployment's rising. Interest rates cannot fall any further. Lending is being severely restricted and will be so for years because the banks are technically insolvent. Public sector spending is being slashed. Where's the growth in house prices going to come from? It's not. Has anyone filled their car tank recently? Is it cheap? Whoever does the grocery shopping, you finding it cheaper than it used to be? Did anyone get the train into London? Is it cheaper than it used to be? How are your taxes doing? Are they going up or are they going down? What's happened to tuition fees, VAT? Anyone who's running a business, are you finding that you're paying your staff vastly more than you were paying them a couple of years ago? Or in fact, are in essence wages and earnings flat? The cost of living is rising above earnings. Here's an interesting chart of food prices. Interestingly, they've doubled in 5 years on the world markets. Although we haven't seen a doubling in our stores, that's because we have some semblance of competition. And it's very interesting. I see that the low-cost operators, Aldi and Lidl, they're taking market share hand over fist. I find it fascinating whenever Tesco, Asda, Sainsbury advertise on the telly. Of course, they always talk about their equivalent. They never talk about Aldi or Lidl. Very interesting, that. Here's an interesting chart for stock market. The FTSE 100, as you see, plummeted in 2008. As I think most people know, it's called the crash. And it's absolutely soared in almost exactly the last 2 years from, interestingly, from the 9th of March 2009. Yeah, 2 years ago. It's practically doubled. Given all the economic problems that there are, for how long is that going to continue? If you're heavily invested in the stock market, in your pensions and your ISAs, just ask yourself that question. How long is that going to continue? Nothing goes in a straight line. And although the stock market has been absolutely fantastic the last couple of years, and anyone who held a lot of cash and invested in the first half of 2009 has done spectacularly well. And I hasten to say, most of our clients did have a lot of cash, because in late 2006, early 2007, we came out of the markets largely, not entirely, but largely. So we did have a lot of cash, and we did start investing heavily 2.5 years ago. But what's interesting, look at the longer term chart of the stock market. The market isn't even where it was 11 years ago. And then when you add on inflation, which has been, what, 20, 30% over the last decade, actually the stock market is a good third in inflation-adjusted terms lower than a decade ago, the top of .com. My point being, as I say, if you're focused on the stock market in your pensions and etc., it's not made you any money in the last 10 years unless your timing has been amazing, and 99% of people do not get that timing right. And given the rising cost of petrol, agricultural produce, copper, iron, cotton, transportation, basically everything, people are simply not going to have the money that they had previously, add on all the debts, to produce the corporate profits that previously were experienced. Thus, don't bank on the stock market just going in one direction, long term. I'll refer you to the Japanese stock market. I don't have a chart on it, but in 1989, the Nikkei Dow was at 40,000. It's now at 10,000, 22 years later. Am I suggesting that the FTSE is going to lose 3/4 of its value? I'm not suggesting that. I'm just saying don't bank on stocks always going up, particularly after a 2-year huge surge. On the other hand, had you been investing in oil and grains and cotton and gold and steel, in other words, commodities and the ilk, yes, it would have been volatile. The sharp drop in 2008 was literally the biggest economic and financial collapse in history, with the bankruptcies of AIG and Lehman Brothers, which I'm sure everyone has some knowledge of. You can't legislate much about biggest crashes in history, but even with that massive crash in 2008, over the last decade, commodity prices have at least doubled, compared with the wider stock market, which is only there or thereabouts, or in real terms has actually fallen. There are ways of making money long term in stock market type investments, in your pensions. Yeah, the number of times I hear, oh, pensions are rubbish. Pensions are absolutely fantastic. You put £1 in, if you're a higher rate taxpayer, you get 40 or 50 pence back. If you're a basic rate taxpayer, you get 20 pence back. It then grows tax-free. You then get a quarter of it back, tax-free cash. It is absolutely sensational way of saving. ISAs are brilliant too. It's totally tax-free. And there are other forms of saving for more complex affairs. Pensions are brilliant. It's what's inside the pension that is at issue. Are you managing it effectively, or are you just leaving it to the markets? Leave it to the markets, I contend it won't help you. You have to take a professional approach. And a professional approach comes in 101 different forms. I know my approach, and my approach for the last several years has been hugely successful. Mr. Valentine, what was inflation in the mid-70s? What do you reckon?
Absolutely no.
No idea? Okay. Anyone else? Sorry?
20%, I don't know.
Brilliant. Any advance on 20%? Retail price index was 25%. 25% rise in prices every year, or for a period of time.
I didn't know.
Yeah. Interest rates were nearly 20%. Think about it, your mortgage at 20%. I'll let you ruminate on that for just a moment. What have we experienced in the last 30, 40 years? We've seen, on a trend basis, inflation fall to not a lot until the last couple of years. We've had China exporting deflation. China is now exporting inflation. We've seen interest rates fall from nearly 20% in the 70s to, what's the interest rate now? 0.5%. They can't go any lower. There's only one direction interest rates are going to go in the medium to long term. There's only one direction. With this level of inflation that we're creating in the cost of living, in the stuff that we're buying for our standards of living. So we've had 30 years, 40 years of a virtuous spiral for house prices. And that in itself has created a virtuous spiral for the economy. Rising prices creates more money effect, more employment, more spending in the public sector, virtuous spiral. But where are we now? As I say, where can interest rates go? What's happening to unemployment? The public sector? The global economy is not rising rapidly. We hear the US is rising at 3 or 4% per annum, which is, of course, an engine of growth for the global economy. Given the level of stimulus America's had, it should be 7 or 10%, according to standard economics. So, just consider where you're investing, where you're saving, and also think about George Soros. He thinks more, I can tell you, not about investment opportunities, but about investment risks before he signs off on an investment. So, thank you very much for your time. I hope that no one's going to hang themselves or throw themselves in the Thames. But that's the reality as I see it, which of course is entirely challengeable. I'm very happy to accept any questions or comments. Try and keep abuse to a minimum.